Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is Tuesday, June 16th, 2026. We're Elena and Marcus.
And looking at our daily desk data this morning, there are really 3 or 4 massive themes colliding all at once today.
Right, which is why the screens look so chaotic right now.
Correct. We've got a massive geopolitical peace deal that's completely cratering global oil prices. We have a brutal reality check sweeping through artificial intelligence stocks. And on top of that, the Federal Reserve is essentially paralyzed right before tomorrow's rate decision, while the Bank of Japan just threw a massive curveball into global currency markets.
It's a lot to unpack. I mean, if you just glance at the surface, you see the S&P 500 closing down 0.6% and the NASDAQ dropping a pretty sharp 1.9%.
Right. But a surface-level read really misses the story today. This isn't just a blind panic sell-off. What we're seeing in today's data deck is a very violent but highly calculated rotation under the hood.
Understood. And the mission for our deep dive today is to really synthesize these conflicting signals for you. We want to help you understand how cheaper energy, shifting AI infrastructure realities, and central bank surprises are all reshaping the broader economy.
And to figure out why institutional capital is rotating so aggressively today, we really have to start with the geopolitical shockwave.
Moving to today's data, we have to look at the sudden collapse in global energy prices. Everything is stemming from Switzerland right now.
Indeed. It's all about the imminent U.S.-Iran interim peace deal. It's set to be formally signed this Friday in Bergenstock.
Right. And
according to our latest run of geopolitical updates, Iran is gaining immediate rights to sell their oil on the global market. Plus, they get access to a $300 billion development fund.
And the reaction in the commodity markets has been, visceral. WTI crude plummeted over 6% today. It settled down at $76.31 a barrel.
Which is a massive move for a single session.
Right. And over the last 4 sessions, we're looking at a 16% drop.
And just to put that in perspective, a 16% drop over 4 sessions. That marks the longest and steepest losing streak for crude oil in all of 2026.
It's a massive amount of new supply.
Correct. The market is instantly pricing in millions of new barrels, flooding an energy market that, frankly, was already looking pretty well supplied.
Which brings up a really confusing point for a lot of investors.
Yeah.
I mean, let's use the first principles rule here. Using simple real-world mechanics, a 16% drop in oil is basically an instant gasoline tax cut for the global economy, right?
Yes, that's a good way to look at it.
It lowers manufacturing costs, it makes shipping cheaper, and it puts cash directly back into consumers' pockets. So if energy costs are plummeting and people are getting relief, shouldn't U.S. markets be rallying? Why are we seeing risk-off liquidations?
Well, the nuance there is how geographically divided the benefits of this deflationary impulse actually are. We tend to view the global economy as this one big monolith, but it's very fragmented. You have to remember the fundamental shift over the last decade. The United States is now a massive net energy producer. So when WTI crude crashes by 16%, it creates a severe drag on domestic energy earnings. And that weighs heavily on U.S. market indices.
I see. So the U.S. indices are dragging because the energy sector itself is taking a massive haircut.
Indeed. But if you look at the international data in our proprietary updates, European equities are catching a huge bid today. Italy's FTSE MIB closed up 1.15%, and Spain's IBX was up 0.69%.
And over in Asia too, right?
Correct. The Korean Kospi surged 2.11%.
And that's because countries like Italy, Spain, and South Korea, they don't pump their own oil. They're massive energy importers.
That is the exact dividing line. For an energy importing nation, an oil price collapse is just a direct, unmitigated positive. It improves their current accounts, stabilizes their currency, boosts consumer purchasing power, all without hurting domestic corporate earnings.
So it's a pure deflationary relief valve for them.
Right. But for U.S. markets, the relief from cheaper oil is just being completely overshadowed by much heavier domestic headwinds. Investors here are distracted by the policy trap being set in Washington.
On that point, let's transition into the macro rates picture. Because theoretically, energy relief should be a green light for U.S. growth. But that optimism is running straight into a brick wall of uncertainty tomorrow morning, which is Kevin Warsh's inaugural FOMC press conference as Fed chair.
And he's walking into a very volatile situation. The Federal Reserve is universally expected to hold the target interest rate steady at the 3.50% to 3.75% range tomorrow.
Right. The overnight index swaps market is pricing it as virtually a guaranteed hold.
Correct. But while the rate decision itself is locked in, bond traders are entirely split on the forward outlook. The data we received this morning drastically complicates Warsh's job. The bond market is terrified of a policy mistake.
Because we just got hit with a huge growth scare in the physical economy. According to our daily desk data, U.S. housing starts for May plummeted 15.4% month over month. That drops it to an annualized rate of 1.177 million.
Right. And that is not just a minor downward revision. That is, housing starts falling off a cliff.
Exactly. So let's look at the math here. We have oil plummeting, signaling slowing industrial demand. We have housing starts crashing, meaning builders are packing up. The economy is clearly tapping the brakes. Yet institutional consensus from places like Citadel Securities is warning about a potential September rate hike because of entrenched inflation.
Yes.
I mean, using first principles again, how does that math work for a regular investor? How can the Fed justify keeping rates high, let alone hiking, when the physical economy is clearly cracking?
Well, to understand that paradox, we have to look at what economists call a bimodal holding pattern. The economy is essentially split.
Yeah.
Yes, the massive drop in oil we saw today is deflationary right now. But the Fed's primary concern is core inflation.
Right, things like services, insurance, rent.
Indeed. And core inflation has remained incredibly sticky because of previous pass-through costs.
So pass-through costs, meaning the high energy prices from, say, 6 months ago, are only just now showing up in the price of a haircut or a shipping contract.
Correct. It takes months, sometimes quarters, for a drop in crude oil at the wholesale level to actually lower the operational costs of a localized business, and even longer for them to pass those savings onto the consumer.
Understood.
So the Fed is looking at sticky core inflation that demands high rates, while simultaneously looking at a housing sector contracting under the weight of those exact same rates.
It's total paralysis. I mean, if Warsh cuts rates tomorrow to save housing, he risks reigniting core inflation just as energy prices stabilize. But if he signals a hike, as dealer desks suggest, he risks pushing a fragile economy into a recession.
And that paralysis is why the U.S. Treasury market barely moved today despite the equity chaos. The 10-year yield dropped a mere 3.6 basis points to 4.435%. The 2-year yield dropped just 1.5 basis points.
Right. The bond market is just holding its breath. Investors are demanding clarity tomorrow. And until they get it, institutional capital is seeking safety. Which brings us to the most violent action of the day, the massive liquidation in technology.
Yes, the tech sector took a beating.
Moving to today's data on equity flows, this toxic mix of high rates and uncertainty is forcing capital to finally pop the hood on the biggest growth engine of the last 2 years, artificial intelligence. For months, any company with AI in its earnings caught a massive bid. But today, that momentum trade fractured.
So NASDAQ took the brunt of it. And the semiconductor complex was crushed across the board. We're not talking about speculative startups here. We're talking about bedrock hardware providers.
Right. Intel was down 8.5%. AMD fell 7.3%. The power management chipmaker MPWR saw a 9.3% unwind.
And this was a broad, concentrated liquidation across logic chips, memory storage, and the physical manufacturing equipment.
And what stands out in today's proprietary updates is that the catalyst wasn't just technical selling. The market is waking up to the physical, dilutive realities of AI capital expenditures. The biggest red flag today is the staggering $80 billion equity raise from Alphabet.
It's a fundamental paradigm shift. When a company like Alphabet issues $80 billion in new stock, they are effectively diluting the ownership stake of every single current shareholder to raise cash.
Which is a huge deal because for the last year, the narrative was that these tech hyperscalers, Google, Microsoft, Meta, generated so much free cash flow from software that they could fund the AI hardware revolution organically.
Correct. But this massive equity raise shatters that. It physically proves that building these data centers and buying tens of thousands of specialized GPUs requires more capital than even the biggest companies can produce on their own.
It's a dilutive reality check.
Indeed. The hyperscalers are spending capital at a rate that has finally alarmed institutional investors. We're moving away from the era of token maxing, where investors blindly rewarded tech companies for hoarding chips, and entering an era of strict ROI skepticism.
They want to see the return on investment. They want to know how these multi-billion-dollar data centers will actually generate profitable revenue.
Right.
But, there's a real irony buried in today's data deck. Because if you look at the labor data and the services sector, AI is actually doing exactly what it promised.
Oh, definitely.
Look at e-com. The engineering and consulting giant was down 12% today. Why? Because the market perceives that AI models are successfully automating their drafting processes, threatening their billable hours.
Right.
The technology works. It's driving productivity.
Yeah.
So using first principles again, if the AI models are successful, why are the hardware companies, the ones selling the picks and shovels, getting absolutely hammered today?
Well, that paradox is the core of today's tech rotation. Our latest run reveals an existential threat buried in the software ecosystem, the rapid evolution of open source models.
Okay, let's break that down.
For a long time, the assumption was that cutting-edge AI could only run on massive, centralized supercomputers owned by big tech monopolies. But today, open source models like Cursor and Llama have become highly efficient.
Right.
And more importantly, they are increasingly capable of running locally on standard edge hardware, meaning they can run on a high-end corporate laptop or local server rather than requiring a connection to a massive cloud data center.
So it's like the big tech hyperscalers just spend hundreds of billions building expensive toll roads for cloud computing, but the open source developers just handed every corporation an off-road vehicle that doesn't even need the highway.
That is the perfect analogy. If highly efficient open source models can handle everyday corporate tasks like drafting emails or analyzing spreadsheets, then the projected demand for premium cloud computing starts to crack.
And if corporations don't need to rent supercomputer time, that directly threatens the future order books for semiconductor giants like AMD and Intel.
Correct. And institutional consensus is already tracking this in real time. The desk notes point out that watching rental pricing for GPUs on decentralized platforms like Vast.ai is the new leading indicator.
Oh, I see.
If the cost to rent cloud compute time breaks lower, it means supply is outpacing demand. It signals that the localized, open source approach is winning, which is terrifying for the hardware valuations we saw just yesterday.
Understood. So capital is flowing out of the expensive infrastructure trade and hiding in safer valuations while the dust settles.
Right.
On that point, while the U.S. market is bogged down debating AI and waiting for the Fed, the rest of the world is taking historic actions. Let's look at the global policy divergence, specifically the paradox unfolding in Asia today.
Yes, looking at the overnight data, the Bank of Japan made a monumental move. They hiked their benchmark interest rate to 1.00%.
Which is the highest interest rate Japan has seen since 1995. It's a generational shift.
It is. But that completely defied basic market mechanics.
Right, because normally, if a major economy raises rates to a 30-year high, you'd expect global capital to flood into that country to capture the yield. And that influx should strengthen their currency.
Correct.
Yet the Japanese yen did the exact opposite today. It weakened to roughly 160.35 to the US dollar following the rate hike. I mean, why is the currency doing the exact opposite of what the textbook says?
Well, to understand why the yen fell, we have to look at the mechanics of the carry trade.
Let's do a quick first principles breakdown of the carry trade for the listener.
Sure. For years, institutional investors have borrowed money in Japan where interest rates were virtually zero. They take those cheap yen, convert them to dollars, and buy a U.S. Treasury bond paying around 4.5%, pocketing the spread.
Right.
Now, when the Bank of Japan raises rates to 1%, the textbook assumes borrowing yen becomes too expensive. The trade unwinds and the currency strengthens.
But that didn't happen.
Because concurrently with the rate hike, the Bank of Japan announced they would pause their bond purchase tapering program until April 2027. Furthermore, Deputy Governor Uchida took a highly noncommittal tone regarding any future rate hikes.
So they raised the benchmark rate slightly, but essentially told the market they'll keep printing yen and buying bonds to keep liquidity flush for the next 2 years.
Indeed. It's like tapping the brakes while simultaneously telling everyone you've cut the brake lines.
Understood.
Currency traders looked right past the minor hike and focused entirely on the fact that quantitative easing is effectively continuing until 2027. That gave them a green light to keep shorting the yen.
So the carry trade survives. They can continue to borrow cheaply in Japan and invest abroad.
Correct. Maintaining this massive global policy divergence.
So synthesizing all of this, we've covered a massive amount of ground today. We're looking at a market where the fundamental rules seem broken. A peace deal causes U.S. tech sell-offs while boosting markets in Italy and Korea. A central bank raises rates to a 3-decade high, and their currency falls. And AI is causing hardware companies to lose nearly 10% of their value.
It's a lot to navigate.
How is an investor supposed to position a portfolio in this environment?
Well, looking at the institutional strategy in our daily desk data, we're seeing a classic barbell approach. You have to balance the extremes. On one end, you don't abandon the secular AI winners, but you shift your criteria.
Right.
You move away from broad momentum and demand real monetization. Lean into infrastructure names with clear, resilient demand that aren't threatened by open source computing.
And the other end of the barbell.
You actively hedge that tech exposure with defensive, rate-resilient sectors. Think financials, healthcare, and industrials that benefit from cheaper energy inputs.
Moving to today's data for tomorrow, we have a massive macro catalyst coming up that could test that entire defensive strategy.
We do. U.S. retail sales data for May comes out tomorrow morning.
Yeah.
This is the crucial physical test of our deflationary oil thesis.
We need to see if the gasoline tax cut from falling crude actually translates into boosted consumer spending at the register.
Indeed. If retail sales hold up, it validates the idea that the consumer is healthy and the Fed can manage a soft landing. But if retail sales crack alongside today's massive drop in housing starts,
it means the U.S. consumer is fundamentally retreating.
Correct. And the pressure on Warsh to pivot and signal rate cuts tomorrow afternoon will become immense.
Which perfectly sets the stage for massive volatility the rest of the week. But before we wrap up, I want to leave you with a final thought to mull over something that wasn't explicitly spelled out in today's data deck, but is the logical conclusion of everything we just discussed.
Go for it.
We talked extensively about the U.S.-Iran peace deal permanently cratering global energy costs. We also talked about the massive capital expenditures required to build AI data centers and how the market is terrified of those costs.
Right.
But what happens when you cross those two structural trends? Right now, the single biggest physical bottleneck facing unchecked AI infrastructure isn't just the cost of microchips, it's electricity. Regional power grids simply cannot handle the gigawatt load required by these massive server farms. But if this peace deal permanently lowers the cost of global energy, could that sudden abundance of cheap power instantly remove the electricity bottleneck?
It's a very real possibility.
Could a permanent drop in energy prices inadvertently spark a second, even more explosive wave of AI infrastructure expansion simply by making data centers drastically cheaper to operate? Keep that question in mind as you watch the tech and energy sectors collide over the next few days.
Thank you for listening to Market Pulse by Orestes Capital. We're Elena and Marcus. We'll be back tomorrow with the latest market color.